With the Federal Reserve Chairman Jerome Powell having turned a little bit more hawkish a few weeks back, the market is now expecting, possibility of interest rate hike, albeit small, happening, probably in 2022 rather than 2023. So what does all this mean? Well, after the initial wobbles in the market, the narrative again has turned positive in that what Jerome Powell is doing is to kind of dampen growth expectations going forward. And that would obviously have an impact on commodity prices, bringing them lower, and therefore the inflation rate target for the Federal Reserve of 2% in 2022 will be a likely outcome, rather than the kind of 5% we're seeing now. So basically what it's trying to do is dampen the kind of growth prospects going forward, which will have the impact of lowering inflation as well. Now this is a kind of a Goldilocks scenario where everything works in the favour of the Federal Reserve, and nothing, not too hot, not too cold. But what could derail that? Well, there's one factor we think could derail that, is that growth might start to slow a little bit quicker than the market's expecting. So, for example, in September, when most of the Western world will go back to the office, schools will start. The question is, will the consumer, who's got a high savings rate at the moment, continue to spend as we've been seeing over the past few months? Undoubtedly, they will be looking to spend more money on travel, restaurants and so forth in the next few months. But thereafter, we feel that once we get back to normal, that the savings rate may well remain high rather than spending. So this could have an impact of two things. One, that demand as supply comes on, the supply chains recover, is actually weaker than the market expects. And therefore you could see growth in terms of GDP starting to be revised downwards. And that would mean that earnings also would have to be revised downwards. And with PE ratio so high at the moment, we would expect that could lead to a market correction.